Let's bring on Hilary Kramer. She's the Chief Investment Officer of Kramer Capital Research to chat more about the market moves. Hilary, thank you so much for joining us. I was reading your note a little bit earlier, and you called this an unsettled moment in the market. We've heard others call this time a time period of an information vacuum. Wondering how are investors supposed to trade through this period of uncertainty that we're having?
The best alternative is to make sure that you have cash set aside. If you have large gains in one particular stock or one sector, it makes sense to trim a bit, because right now everything is so overpriced and is so highly valued simply because we have this asset bubble that was created because the printing presses have been going now for over 6 months. And there will be opportunities again to buy, and we will see some serious dips in the market. And they could be as bad as what we saw on that down day of March 23rd.
So to your point of trimming on some of these stocks, tech comes to mind, because for so many investors for several months that we saw that run in the market, tech was everything to a lot of people. Right now, wondering where you see tech going over the next 6 months, 12 months. And if you think folks right now, we are starting to see a rotation. If you think folks need to start trimming on some of those big tech names and perhaps start looking over at cyclicals at value.
Absolutely. So in terms of tech, Amazon, we still see as being a strong company that will go higher. It's not necessarily the right entry point here, but Amazon will still continue to take business away as we go into the holiday season from traditional retailers, especially the ones that have been able to sustain. But for example, I have sold my Dick's Sporting Goods because it came back, it had a great recovery, but ultimately this is going to be a very different holiday season. But still, Amazon is strong. I am not optimistic about Apple's big announcement to come on October 15th, because even with the new introduction of Apple iPhones, remember that the entire purchasing cycle has been brought forward because so many people had to set up their work from home environment. A lot of those purchases have been made, and there was a lot of money sloshing around from those PPPs, those emergency loans. Every single person I speak to, every colleague has stories about where the money has been misspent, and it's been spent and it's gone. And even though with this new stimulus it'll be forgiven, we have to be mindful that we had a once in a lifetime sort of free-for-all that took place, and it was necessary at the moment. And well, especially necessary was a $600 supplemental unemployment that went to individuals. But we have seen a lot of purchasing in the market come back because of that. Where would I go? So you ask about cyclicals. General Mills right now is still $10 off of its all-time high, which was set in 2016. It's $62 stock. General Mills, their quarter ended August 30th, year over year, saw a 27% increase in earnings per share. The company does $17.8 billion in net revenue a year. It is going on all cylinders because they have gone into every area of organic, like Annie's, for example, and created the healthy snack category, which includes Nature Valley. But when the pandemic really began in March and April, anyone who's in the supermarkets knows that gold medal flour, Pillsbury flour, baking products just flew off the shelves. And there are even some people that will still want their Cheerios every morning, but we're talking about a company, General Mills, GIS, that has 3.3% dividend yield and sells Progresso soup. So I would stick with a company like General Mills in that low 60s range, because you at least get that 3.3% dividend yield. Hormel, HRL, yes, it's gotten fully valued in many ways, but still there's an onslaught of buyers that come in when it looks like we're in a recessionary, depression-oriented market, because they think of spam as the ultimate defensive play, which is what Hormel makes, in addition to also owning Skippy, which is a very important brand that is considered one of the most defensive of all the foods out there, Skippy peanut butters. And so I like that. But there are also opportunities in the banks. We've been doing a lot of analysis on looking at companies like PayPal, as well as the traditional banks. And what we've come up with is that as much as we love JP Morgan, and JPM is always a buy at any price, I really believe that, there is credit risk, there is default risk there, where you don't have that same kind of credit risk with the companies like PayPal that own Venmo, for example. But Morgan Stanley trades at less than 1 times book value. MS, I think Morgan Stanley, you have the 2.9% dividend yield, a real emphasis on consumer, which grew out of 20 years of working on the brokerage industry, especially taking and buying from Smith Barney, those brokerage accounts. And Morgan Stanley is just so much more now than an investment bank. It's an asset gatherer. So
Right.
even though assets may dwindle, that's another great play for those that want some safety. And it's time even for the NVIDIAs, which are amazing companies. They just keep going higher and higher. It's like, okay, we've rotated out of Netflix and buying up Apple, but
Right.
now the next in line has been NVDA. That one, we'll see a correction as well. It's inevitable.
Right. Well, some names for us to think about. Thank you so much for joining us today, Hilary Kramer, Kramer Capital Research Chief Investment Officer.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.